Hi, everybody. Welcome back to another episode of Tax Sale Insiders. I'm your host. I'm Brian Seidensticker. I'm the CEO of Tax Sale Resources. And with me today is, I guess, not a newcomer. We've had you on a few times, Randy Saunders from Nelson Mullins. Randy, welcome back.
But I'm happy to be here.
Yeah. And I guess I know you're kind of an expert in a couple different states, but we've touched base on West Virginia in the past. We did a full, review of how the state works, and then lucky enough, the state went and changed the rules on us. So I don't know that we want to dig into all of the nitty gritty details today, Randy, but I'd love to help answer some of the questions we received, which is basically, hey, what has changes? What does this mean, for investors? And can you kind of just walk us through what the changes were? What does that mean from how the sale occurs, how the interest is calculated, and so forth?
Yeah, happy to. And it's funny because just about the time everybody gets comfortable with the process, they go and they amend it, which it really only makes the attorneys happy because. Then you got to come back and talk to us and figure out what's going on. So, so Senate Bill 552 went through, and we're now in this first year of the changes in the transition. And I say the biggest part, I think there's two kind of overarching themes. One, the legislation was intended to favor, in some respects, West Virginians over out-of-state interests, and then also there was a desire to kind of centralize some of this to the state auditor's office away from each of the 55 counties in the state. But when you look at what was articulated in the press by those that pushed and passed the legislation, so the purpose was to streamline the tax sale process in West Virginia and to save the state money. And then according to the message from the West Virginia Auditor's Office, the policy behind the new changes, and this is paraphrasing, but it was to keep out-of-state buyers from getting a preference, to eliminate interest, to help homeowners save money, and then to encourage purchasers to buy properties as investment in the communities. And I'll start there. So when you look at the amendments to the different articles, there was a purpose that was added to 11A31, and it was looking at the transfer and sale of delinquent lands is meant to be made to those who will make beneficial use of the lands. And again, this goes back to that idea that if out-of-state investors are coming in and they're gobbling this property up and then they're not doing anything with it, you want the highest and best use of the land. You want to make sure that it's being developed and utilized. And so that was kind of interesting, though, to see them actually go in and add a purpose to the sale to actually say, not only what we've traditionally seen, but also we want to make sure that the tax sale process in West Virginia is geared toward and beneficial to those that want to use and develop the land. Now, what I will say is a lot of my clients that are out of state do come in and they purchase these tax liens, and if they get the property, they are either developing rental markets or they are improving the property and reselling it. So it's interesting, and I'm not sure where the idea came that there's all these out-of-state interests coming, gobbling up these properties and not doing anything with it. But apparently that was something that I haven't seen the data on it, but it was something that was believed to be an issue. But I will say, from my perspective and in dealing with my clients, it's not something that I have seen. Traditionally, when you look at the investors, they're going to try to make money. You either make money by redeeming or you make money by acquiring the property, and then you've got to utilize it. You've either got to utilize it through rental market or through resale markets. So you don't get a lot of my clients that just come in and sit on the properties. Now, what I will say, if we're not dealing with residential, if we're dealing with mineral rights, or if we were dealing with undeveloped property, I could see that where folks come in and maybe they acquire a large tract of undeveloped property, or they acquire large tracts of mineral rights, and they don't do anything with it. But again, when we're looking at our industry, Brian, we're talking about 90% of the time we're talking about acquisition of residential real estate properties. And so if all of this was put together, it might address non-residential properties, but I'm not sure how applicable that concern is to residential real estate. The next thing, it talked about making it easier on the delinquent taxpayers. Now, there's two reductions in interest rates, and this has caused some confusion. So, the one that's most relevant to investors is going to be the interest rate that's due for the redemption of the real estate. So, it used to be 12%. That's been reduced now to 7.5%, which is still not bad, but it is a reduction, obviously, so it's a little bit less attractive than it had been. The other reduction goes specifically to the taxpayer, and this is when they become delinquent. The tax the interest that's equated to that tax bill was reduced from 9% to 3%. And so, I've talked to a lot of people where that's caused a lot of confusion, because they see that 3% and then they're like, my goodness, did it go from 12% all the way down to 3% when I get my interest on my redemption? And no, but what that is, the interest that's attributable to the taxpayer, the interest that the investor can obtain at the point of redemption, it was reduced, but it was only reduced down to 7.5%. And that's probably one of the main questions and concerns that I get, because there was so much discussion in the media, and when you kind of Google this and read about what are these changes, it talks a lot about making it easier on the taxpayer, the burdens on West Virginia citizens, and it talks a lot about this 3%. And so I think there's been a lot of confusion. Obviously, 12% down to 7.5% is significant. 12% down to 3% would have been, I think, catastrophic, because I think at 3%, it takes a lot of interest out of coming to West Virginia to acquire these.
Right.
And so then looking at it, when we look at the old structure, so if we say, let's just look at how the process worked prior to the change and how the process works now. So before, what would happen is there would be a sheriff's sale in each county, each of the 55 counties, and those sales would take place usually in October or November. Then you would have 18 months, and during that 18-month period, it could be redeemed. At the close of that, when you get into March or April, not the following year, but the year after, because you're waiting that 18-month period, you would go down to the county, you would request issuance of a tax deed, and it would be issued. And then you would take, assuming it had not been redeemed, you would take that property free and clear of any encumbrances, and the due process period for challenge would take place the 3 years after that. Statute of limitations would run 3 years. So anybody that didn't get notice, or that if they had a complaint, they were trying to set aside that tax sale, they would do that in 3 years from issuance of the tax deed by the county clerk. Now what's happened is, you've still got, so in West Virginia, you've got your assessor who assesses the property. You've got your sheriff who's responsible for collecting the taxes. And now the sheriff's going to be communicating with the auditor, and it's going to be providing that information to the auditor. There's a certain point at which you can redeem from the sheriff. And so the property may be redeemed from the sheriff prior to the certification to the auditor, and may be redeemed from the auditor after certification with payment to the deputy commissioner. So there basically, once it's communicated from the sheriff to the state auditor that these are the delinquent taxes. It's now in the hands of the state auditor. So that's going to be a little bit different because you're not just dealing with the sheriff and you're not redeeming with the sheriff. There's up to a certain point of time, and that is before August 10th of each year. After August 10th, then you're going to be dealing with the auditor. And what's a little bit different is the auditor then is going to have the sales, and they're going to be in each of the counties, but those sales will take place between, dates right, I believe it's now between May 1st and October 1st of each year, which is significantly different because, you weren't starting until October and November. And now you think, and it was a 2-month period. Now you're going from May to October. That's a much more, extended period. And I think this is one of the things, in my opinion, that is a little bit more advantageous for all investors, regardless if they're in state or out of state, because you had 55 county sales in a 2-month period. It was a little more difficult to get to all of them, maybe, or, and you're picking and choosing.
Logistically, it's a challenge. Yeah, for sure.
Right. Now you've got from May 1st to October 1st. And, you've got more time to get into each of the counties and decide which counties you want to go to. What I would say is I preface that with saying, and we've talked about this before, Brent, where I think there are certain counties that are more beneficial than others. I think, you want to look at, where your resale market is. Because, again, when we talk about West Virginia is still a state, even after these changes, where I believe it is much more likely that you'll end up with the property than in most states. Because, again, you've got this period of time where they can redeem. And if it's not redeemed, you still will seek a tax deed. The difference is, and I was going to get to this. I'll go ahead and jump to it. Again, under the old statutory scheme, you requested the tax deed from the county. Now you'll request the tax deed from the state auditor. And what happens is the redemption period is now all the way up until that deed is issued by the auditor. And, it used to be like you'd walk in, you'd get your tax deed. Now, and we haven't seen this yet, obviously, because it's going through the process. This is the one thing I really want to watch is how long is it going to take, and is there going to be a backlog because you've got one office doing all of these for all 55 counties? And how is that going to play out? As far as once you make that request, how long is it going to take to get it? And how is that going to maybe work against the investors? Like if it sits there for 2 months and then you get a redemption that comes in and he still hasn't issued the tax deed under the statute, you don't get the property, it's going to be redeemed. And so I think that is something we want to watch. And I'm sure they're making preparations and have everything in place to handle that. But it's going to be something that's new. You're used to having that handled at the county level and the county issuing, 55 different counties issuing tax deeds. And for one county, that's probably not that significant of a carry each year. Now, if you've got one entity handling all of that for all 55 counties, it's just going to be interesting to see. And I, maybe in year 1, year 2, there might be some backlog and some growing pains, but I think that's something that we want to watch. I think one of the other big changes is for the first time, we talked a lot about in the past in Kentucky, like payment plans. And in West Virginia, there was really no payment plan, no provision for that, no requirement for it. Under 11A356 now, it gives the owner the right to redeem with no more than 3 incremental payments. So the owner, if they have financial hardship and they can articulate and demonstrate that, can petition to the auditor for a redemption and can break it up in up to 3 incremental payments. Now, again, they put a limitation, but I think this limitation is still going to apply to most of the folks that are going to be watching this broadcast, because it's only for properties that are primary residence of redeeming parties. But I think for most of what we're dealing with, that's, other than maybe rental properties, but it's all, most folks I'm dealing with, it's all residential. So really for the folks watching this, that is going to be something new that will impact. And so what's the big deal there? Well, the big deal is that if we're looking at redemption rates, I'm not sure exactly how much this will increase redemption rates, but traditionally what I've always said is if you really want to go after the property, talk to you, because you've got services that you can provide to help people understand, is the property encumbered, and is there a mortgage on the property? If there's a mortgage on the property, it's much more likely that lender servicer is going to show up and is going to redeem, because one, they don't want to lose their secured collateral, and two, let's say it's escrowed, they don't want liability in losing the property, so they're going to show up and redeem. If it's not encumbered, then it's much more likely that you're going to get the property in West Virginia, because you don't have a third party showing up, and if they're behind on taxes and things, it's a pretty good chance they're not going to have the funds to redeem. So what this does is it allows for the payment plan, allows for folks to break it up. And so I can understand why the state wants to do this, wants to help people have a better chance to redeem if they can't come up with all of that cash at one time. But I think ultimately what it does is it creates a little bit more of a cloudy picture when you're trying to read the tea leaves, or you're trying to estimate here, okay, if I acquired 10 properties, 6 of them are unencumbered, 4 of them are encumbered. These 4 I'm probably going to get redeemed. These 6 I've got a good chance of getting. Now there's kind of this new dynamic there of, well, how do you handicap the fact that they can do this payment plan? And is that going to cut into my ability to actually obtain the property? So, again, I think when you're looking at it, there's going to be more consistency, because again, you're going to have it centralized with the state auditor's office. You've got all of your counties that are still going to be doing their jobs and providing the information to the state auditor's office, but I think you're going to have more consistency in how it's handled. I think from the interest rate standpoint, there's not that big of a decrease where I would still say it's not advantageous. And again, I've always liked the interest rate in West Virginia. Brian, you and I have talked about that before. But to me, the real hook in West Virginia is the opportunity to acquire property, and then what you can do with that afterwards. Again, going either into rental or to resale. Because I think that's where you can, if you're doing your due diligence and you're getting properties in good locations where they can either be rented or resold, that's where you're going to really get your return on investment. So, I don't know that West Virginia was one that I always would have recommended simply by saying, hey, 12% interest rate, that's the golden ticket. I think the interest rate is still favorable enough that even if it redeems, that's going to be beneficial. But the real play is trying to acquire those properties and take advantage. And so, I was just going to say, I don't, I guess, and again, when we look at this overarching theme of favoring in-state versus out-of-state and making sure that the property is utilized, I guess I just don't, for what folks watching this and looking at it, investing in kind of our industry, I don't think this impacts them negatively enough to where you would say, hey, this still isn't advantageous.
I guess from what you said, there's statutes out there like Missouri where they, specifically state you'd have to be a resident or have an agent in the state, but they didn't add anything like that in this case, right? So there's nothing like trying to eliminate out-of-state investors. So I agree. I think maybe that was, part of maybe the hope or plan, but I can't say anything that you've said would make, me, I'm not every investor, but make, if I were an investor, say, this is just not friendly, other than, interest rate going down can hurt, right?
Right.
I'd say with Fed rates the way they are, anybody utilizing leveraged funds, right, might shy away because, they used to be able to cover their leverage at the 12%. Now
Right.
they probably can't, right? And I don't know how many, folks were using leveraged funds in West Virginia to begin with, but if they weren't to begin with, I don't think it really changes that. The end game, as you said, is most likely the chance of owning that real estate. If you don't mind, I want to kind of summarize a couple things just to, where these changes might hit as far as process in the whole scheme of things. So starting with the way the sale is conducted, the only difference there is it's now conducted by the auditor instead of the sheriff, correct?
Yeah. And so when you look at that too, the auditor's office is still going to hold the public auctions in the county courthouses. And that's why you're looking at May through October. And that, I'm sorry. And so May through October is for the non-entered lands. April, May, June are where they're going to do the Class 2 properties specifically. But again, you look at that period of time, and that will allow their office to go to all 55 counties. So it's not like you've got to show up in Charleston every time for it. You're still going to go to the county courthouses, but it's all going to be orchestrated by the auditors.
Remind me again what's a Class 2 property?
So when we look at Class 2, that's where we're looking at residential properties. So not commercial properties, not and it's just there are classifications that are set forth in statute in West Virginia.
Got it. Okay, so the sale is still going to occur roughly the same location, might be a different person conducting it, but it's basically the same. Now, as far as the bidding method is the same, which remind me was premium bid, correct?
You know what? Let me. That is one. My understanding is yes, that the bidding method has not changed, and I did not put that in my notes. I apologize, Brian, but I'm assuming because it's not in here that the bidding method has not changed. Yep. Sorry.
And we can circle back on that one, as a follow up. But so it's still a premium bid method, correct? If I remember right, yes. In West Virginia. Okay, so the premium is still bid. There's still zero interest on the premium. Is that?
Yeah. So if the property sold, the redemption is back taxes plus fees until the deed is issued. And again, it says so under 11A338. Person seeking redemption must pay the auditor any of the following that may be due: taxes, interest, and charges due on the real estate on the date of certification to the auditor, with interest at the rate of 7.5%. All taxes assessed for the year in which the certification occurred, with interest at a rate of 7.5% from the date they became delinquent, and all taxes except for the current year, which would have been assessed since the certification. So when they look at from a taxpayer standpoint, what they're going to have to pay for redemption. But yeah, a lot of people ask, what exactly do I get interest on? So that was a good point, Brian.
So just the tax amount will earn that 7.5. The premium will still be zero, which is no change there, right?
Right.
So as far as conducting the sale, I'd say interest rate change, but not a whole lot outside of that. I'd say the redemption period is roughly the same, other than it now you can redeem all the way through the deed being issued. As you mentioned, now the fact that the state auditor is doing that for all 55 counties, right, used to be fairly quick. We'll see if that continues. Does interest continue to, and this might be the devil's in the details of who, we'll see how this plays out, but does interest continue to accrue all the way up until that, or is it change anything?
Yeah, so even I think at that point, because when you look while it's sitting there, you're simply waiting at that point for the deed to be issued. If somebody then shows up and says, "Hey, can I still redeem?" My take on my reading of the statute. Obviously, this hasn't played out yet, but I think it would all be calculated from the date of that request and then the date that the payoff is made. So when you look at it, you get a redemption amount through a certain date, but it would be calculated at that point. So it's not like the interest would stop running on the date that you requested your deed, because that is separate and distinct from redemption. And so if they show up and it's been sitting there for 30 days, but it hadn't been issued yet, and they say, oh, hey, can I redeem? Then, yeah, my read on it is that you would still, the calculation would be through that date that it would be determined from that date, but it would actually be the date that they pay it. So, you've got your per diem that would go. So say, hey, this is what's due today, interest rate calculated through today, and then this is your per diem to add, whatever day you actually make the payment.
Got it. Okay. And then
now an interesting question. Here's one interesting question that I'm not sure, and something to look at is with the payment plan. If you lock into a payment plan and you've got 3 payments over a 3-month period, how is that interest going to work? So that's something, and that's maybe something we could talk about next time.
Yeah, how that's going to work. And then I think the other was like, when is it considered redeemed, right? After that first period or after the third payment? Like that'll be a nuance that'll be interesting to watch as well.
Well, what they're going to find is, because I've seen this in other states, is, or even if you look in the mortgage industry where you've got like a loan modification and you've got to make 3 trial payment payments, you might make the first 2 and then you miss the third. So what's going to happen with all these folks that pay in money and then they make 2 payments and then they miss the third? And it's going to be interesting just to see how that plays out as well.
Yeah. That'll be interesting to watch. And then, as far as the end of the process, there's no change to the type of deed you're getting, right? That's the same. So overall, it sounds like, correct me if I'm wrong, it sounds like the biggest change is just the change in interest from 12 down to 7.5. There's other nuances that I think everyone needs to know, from who's conducting the sale and then how long that redemption period is and so forth, this payment plan addition. But the biggest impact is going to be that change in interest. Were there any, is it only this year going forward? Did they say that's not going to be retroactive at all, correct?
Right. It's going forward. And I think, the other big factor I would say is kind of the centralization of power, for lack of a better word. Instead of having 55 fiefdoms, you've now got the state auditor's office, who's really going to be overseeing this. And so in some ways that will be good, because you'll have clarification on issues, you'll have consistency across the board, and you won't have 55 counties maybe doing certain things different ways. But in some ways too, it could be maybe less advantageous to some of our, viewers, because I don't know, just based on when you read, the press releases and you read this, I don't know that it's ever going to be overly favorable to investors in state or out of state, so.
Right.
It's almost like in baseball where tie goes to the runner. I think that in these circumstances, kind of that's the mentality you want to have as an investor, is understanding that, if it's a close call, I would expect that it's going to benefit the taxpayer.
Yeah. Okay. What one last question, only because it's the hottest topic of the day these days, but the recent Tyler versus Hennepin case, which I know the property itself is based in Minnesota, but I think the potential ramifications of that, are further reaching. But I know you don't have a crystal ball, but would you anticipate any additional changes potentially coming down the pipeline as a result of that Tyler Hennepin case?
Not like specifically in West Virginia, or
just specific to West Virginia.
I don't think in West Virginia we will. And there's a few reasons for that. I think that when you look at the structure in Minnesota and some of the other states where that's more of an issue than it is in West Virginia, but also where we just we joke often. I mean, I think this was the first time, and I can remember forever, that the Supreme Court of the United States took up tax sales. When you're looking at your political livelihood and what a hot topic is for legislators and stuff, they kind of went in and looked at all tax things last couple of years and kind of tried to do some restructuring of not just tax sales, but a lot of tax issues. I don't foresee them delving back into that, especially just based off of that decision. Now, I will say, I do think that decision is going to have some. And I know Matt and Jonah spoke a little bit about it, so I don't want to steal their thunder or say something opposite. No. But I think because they're very smart. No, but I think that it's going to have wide-ranging impact because I'll leave it at that. It'll be interesting to see kind of the reaction that some states have to that decision and how they're going to try to continue their statutory scheme, or if you're going to have overhauls of statutory schemes because the statutory scheme is now not going to be as advantageous as it was based on that rule.
Right.
So right. I think where you could see it is states that have a scheme that's more similar to Minnesota than West Virginia, to see if those states and their legislatures are going to say, hey, based on this, we may need to come up with a new strategy. And I think that's where we're going to have a lot to talk about. Because if we see that in the next 12 to 24 months, and I really do believe, and I don't want to get too long, that's why I was trying to boil it down into kind of a concise answer, which isn't always my strength. But I think that's where you're going to see kind of the wide-ranging impact is what is the reactionary steps that each state takes in their code to address their tax sale process. Right.
Well, Randy, I appreciate the summary. I think, like you said, there's going to be some nuance to this. We'll probably talk about it a few more times related to the payment plan process, the redemption amount calculation, and how it plays out with the state auditor handling the issuance of all the deeds. So anyway, I appreciate it again. Thanks for coming on and educating everybody.
Well, thanks for having me. I appreciate it.
All right. Thanks, everybody. Good luck.
Take care. Thanks. Bye.